Today, we're going to dig into a really fascinating strategic note. It looks ahead to 2026 and makes a pretty bold argument that a huge single trend in the stock market, when you mix it with all this growing global instability, is actually forcing a massive shift toward one of the world's oldest assets, physical gold.
And this chart right here, this shows you the problem immediately. The S&P 500 is supposed to be this broad benchmark for the entire US stock market. But look at this. A tiny handful of AI-related mega companies now make up a staggering 35% of its total value. That means trillions and trillions of dollars in savings all over the world are riding on one very, very narrow bet.
Which, leads us to the one big question that's driving this whole analysis. In a system that's this concentrated, what on earth happens if that single dominant bet on AI starts to go sideways?
All right, to answer that, we're going to walk through 5 key steps. First, we'll look at just how concentrated the market is. Then we'll zoom out to the fragile global backdrop. We'll look at how money itself is being weaponized, see what central banks are doing about it, and finally, we'll land on the case for physical gold as a unique hedge.
Okay, so let's just dive right into Section 1, a one-themed stock market. This is all about just how lopsided things have become.
I mean, just look at the performance gap here. It's wild. In 2023, the so-called Magnificent Seven and their buddies soared by around 76%. The S&P 500 as a whole, it only managed 24%. This isn't just a strong performance by a few stocks, it's total dominance. The entire market's fortunes are now basically tied to a handful of names.
Now, according to the source material, this creates 3 big layers of vulnerability. First up, you've got narrative risk. The prices of these stocks are based on this story of just unstoppable, amazing growth that, might not last forever. Second is mechanical risk. See, as more and more people buy simple index funds, those funds are forced to buy more of these giants, which just pushes their prices up even more in a kind of feedback loop. And finally, and this is the big one, systemic risk. These companies are now so huge that if the AI bet sours, it could drag the whole market down with it.
Okay, let's move on to Section 2 and see how this all connects. We need to zoom out from the market itself and look at the world it's actually operating in.
Because this isn't happening in a vacuum, right? This timeline shows that recent years have been all about escalating geoeconomic conflict. You've got trade wars, you've got the freezing of an entire nation's foreign reserves. The whole global system is getting more fragmented, more politicized. These aren't just random events, there's a clear pattern here. And this leads to a really crucial insight. When the market is this concentrated in American tech giants, companies that absolutely depend on global supply chains and markets, investing in the S&P 500 isn't just a simple bet on American business anymore. It's now a very concentrated bet on American geopolitical stability in a world that feels more and more unstable. This brings us to a real turning point. And that's our third section, when money becomes a weapon. We're going to focus on that moment in 2022, when Russia's reserves were frozen.
The scale of this is just, breathtaking. Roughly $300 billion in another country's central bank assets were just immobilized. This was using the financial system as a tool of power on a scale we've never really seen before.
And the fallout from this was profound. For decades, there was this unwritten rule. Countries held their reserves in dollars or euros, with the understanding that this money was sacred, it was neutral, it was totally safe. Well, the 2022 freeze just shattered that assumption for countries all over the globe. The rulebook was torn up.
So if you're one of the world's big financial managers, a central bank, what do you do now? How are you responding? Well, that's our 4th section.
The data here is just undeniable. This chart shows such a dramatic shift. Before 2022, central banks were buying on average about 500 tons of gold per year. After 2022, whoa, that number has more than doubled, consistently blowing past 1,000 tons a year.
Let's just pause on that number for a second. Over 1,000 tons per year. This isn't some small adjustment. This is a historic, tectonic shift in how the world's biggest financial institutions are managing their money. They are actively looking for something else.
And as the source note puts it, this really hits the nail on the head. This isn't a short-term trade. It's a long-term structural response. It's a deliberate shift toward a neutral reserve asset, something that can't be frozen or devalued by another country, in a system where currencies are now being used as weapons. Which brings all of these different threads together in our final section, the case for physical gold and why some see it as a hedge against these new kinds of systemic risks.
Now, to really get this argument, we have to understand this one concept, counterparty risk. It sounds a little jargony, but it's really simple. It's the risk that someone you're counting on won't hold up their end of the bargain. See, most financial assets, stocks, bonds, even money in the bank, are really just a claim on someone else. They all have this risk baked in.
This is where physical gold is totally different. When you hold the physical metal yourself, there is no counterparty. You hold the asset itself, not just a promise from somebody else. A gold ETF, on the other hand, well, that's just a claim on gold held by a third party, which brings back all those political and intermediary risks you might have been trying to avoid in the first place.
So what does this all mean for you? Well, the source proposes this sort of four-step framework. Step 1, acknowledge the huge concentration risk in stocks. Step 2, diversify your assets. Step 3, address these new political and custody risks. And the final step is a strategic allocation. The note suggests something like 5 to 15% to physical gold.
And it's so important to get this next point. The goal here isn't to try and predict a crash or time the market. It's about building a portfolio that's resilient, one that's tough enough to handle the new realities of a super concentrated market and the weaponization of finance.
And so, that really leaves us with one final thought. As we look ahead to 2026 and beyond, with all these huge structural shifts in play, the key question for every investor becomes pretty simple. Is your portfolio prepared for a fragmenting world?